Accounts receivable and accounts payable are two fundamental pillars in the realm of accounting, forming the backbone of every organization's financial operations. Their proper management not only ensures the smooth functioning of business cycles, but also plays a critical role in maintaining liquidity, assessing creditworthiness, and fostering healthy relationships with customers and suppliers. To understand the nuances of accounting for accounts receivable and payable, it is essential to delve into their definitions, recognition, measurement, recording procedures, internal controls, and the strategic significance they hold within the broader framework of financial management. Accounts receivable, AR, refers to the outstanding amounts that a company is entitled to receive from its customers for goods or services delivered on credit. In other words, when a business allows its customers to buy now and pay later, the resulting claims are recorded as accounts receivable. These are classified as current assets on the balance sheet, as they are expected to be converted into cash within the normal operating cycle, typically within 1 year. The process begins when a sale is made on credit, an invoice is issued to the customer, and the amount is recognized as a receivable. Conversely, accounts payable, AP, represents the amounts a company owes to its suppliers or vendors for goods and services purchased on credit. This liability arises when a business receives goods or services but has not yet paid for them. Accounts payable are recorded as current liabilities on the balance sheet, reflecting the company's obligation to settle these debts within a short period, usually 30 to 90 days. The efficient management of accounts payable is crucial for maintaining good supplier relationships and optimizing cash outflows. The recognition of accounts receivable and payable is governed by the accrual basis of accounting, which dictates that revenues and expenses are recognized when they are earned or incurred, rather than when cash is received or paid. Under this principle, a business records sales revenue and the corresponding accounts receivable at the point of delivery of goods or services, irrespective of when the payment is actually received. Similarly, purchases made on credit are recorded as expenses and accounts payable at the time the goods or services are received, not when the payment is made. Measurement of accounts receivable and payable is generally straightforward, as they are initially recognized at the invoice amount. However, companies must consider potential adjustments, such as sales returns, allowances, and discounts, which may reduce the gross receivable. Moreover, not all accounts receivable will ultimately be collected, necessitating the estimation of uncollectible amounts through the allowance for doubtful accounts. This allowance is a contra-asset account that reduces the net realizable value of accounts receivable on the balance sheet, reflecting management's best estimate of probable credit losses. The recording of accounts receivable begins with the issuance of an invoice to the customer. The journal entry involves debiting accounts receivable and crediting sales revenue. When cash is eventually collected, the entry is reversed by debiting cash and crediting accounts receivable. If a customer fails to pay, the company may write off the amount as a bad debt expense, reducing both accounts receivable and the allowance for doubtful accounts. Periodically, companies review the aging of accounts receivable to assess collectability, making necessary adjustments to the allowance account based on historical experience and current economic conditions. For accounts payable, the process starts when an invoice from a supplier is received and verified against purchase orders and receiving reports. The entry involves debiting the relevant expense or asset account and crediting accounts payable. Upon payment, accounts payable is debited and cash is credited. Effective management of accounts payable requires timely processing of invoices, taking advantage of early payment discounts where available, and ensuring payments are made within agreed terms to avoid late fees or damage to supplier relationships. Internal controls over accounts receivable and payable are vital to prevent fraud, errors, and misstatements. For accounts receivable, controls include segregation of duties, regular reconciliation of subsidiary ledgers with the general ledger, authorization of credit sales, and prompt follow-up on overdue accounts. For accounts payable, controls encompass proper approval of purchase orders, matching invoices with supporting documents, periodic vendor statement reconciliations, and secure handling of payments. The implementation of robust internal controls not only safeguards assets but also ensures the accuracy and reliability of financial information. The management of accounts receivable and payable extends beyond mere record-keeping. It involves strategic decision-making aimed at optimizing working capital and enhancing liquidity. Efficient accounts receivable management seeks to accelerate cash inflows by shortening collection periods, implementing effective credit policies, and employing proactive collection efforts. Techniques such as credit analysis, setting appropriate credit limits, and monitoring customer payment patterns help mitigate the risk of bad debts and improve cash flow. On the other hand, accounts payable management focuses on optimizing cash outflows by extending payment periods without jeopardizing supplier relationships or incurring penalties. Companies often negotiate favorable credit terms with suppliers, utilize trade credit as a source of short-term financing, and prioritize payments based on due dates and available discounts. The goal is to strike a balance between maintaining sufficient liquidity and leveraging supplier credit to support operational needs. The interplay between accounts receivable and payable significantly impacts an organization's cash conversion cycle, CCC, which measures the time taken to convert investments in inventory and other resources into cash flows from sales. A shorter CCC indicates efficient management of receivables and payables, contributing to improved liquidity and financial flexibility. Companies continuously monitor key performance indicators such as days sales outstanding, DSO, and days payable outstanding, DPO, to assess the effectiveness of their working capital strategies. Technological advancements have transformed the accounting for accounts receivable and payable with the adoption of integrated enterprise resource planning, ERP systems, automated invoicing, electronic payments, and advanced analytics. These tools enhance the accuracy, speed, and transparency of transaction processing, enable real-time monitoring of outstanding balances, and facilitate data-driven decision-making. Automation reduces manual errors, streamlines workflows, and frees up resources for value-added activities such as credit management and supplier negotiations. Accounting standards provide comprehensive guidance on the recognition, measurement, and disclosure of accounts receivable and payable. International Financial Reporting Standards, IFRS, and Generally Accepted Accounting Principles, GAAP, require entities to present these items separately on the balance sheet, disclose significant accounting policies, and provide information about credit risk, aging of receivables, and liquidity risk. Transparent reporting enhances the credibility of financial statements and supports informed decision-making by stakeholders. Accounts receivable and payable are not immune to risks. Credit risk, arising from the possibility that customers may default on their obligations, poses a significant challenge in receivables management. Companies employ various risk mitigation strategies, such as credit insurance, factoring, and securitization of receivables, to transfer or reduce exposure to credit losses. Factoring involves selling accounts receivable to a third party, the factor, at a discount, providing immediate cash inflow and shifting the risk of non-payment to the factor. Liquidity risk associated with accounts payable arises when a company is unable to meet its short-term obligations as they fall due. Maintaining adequate cash reserves, establishing lines of credit, and forecasting cash flows are essential practices for managing this risk. Companies must also be vigilant about concentration risk, where dependence on a few major customers or suppliers could disrupt cash flows and business continuity. The role of accounts receivable and payable in financial analysis cannot be overstated. Analysts scrutinize trends in receivables and payables to assess a company's liquidity, operational efficiency, and credit management practices. Ratios such as the accounts receivable turnover ratio and accounts payable turnover ratio provide insights into how effectively a company is managing its credit relationships. A high receivables turnover indicates prompt collection, while a low payables turnover may suggest delayed payments or strained supplier relations. From a tax perspective, the timing of recognition and deductibility of accounts receivable and payable can influence taxable income and cash tax obligations. Tax authorities may prescribe specific rules for recognizing bad debts, valuing receivables, and deducting payables, requiring careful compliance and documentation by businesses. Accurate accounting for these items ensures proper tax reporting and minimizes the risk of disputes or penalties. The global nature of modern business introduces additional complexities in accounting for accounts receivable and payable. Transactions denominated in foreign currencies require translation at appropriate exchange rates, giving rise to foreign exchange gains or losses. Cross-border sales and purchases may involve different credit terms, payment methods, and legal frameworks, necessitating robust processes for managing international receivables and payables. In certain industries, such as retail, manufacturing, and construction, the volume and complexity of accounts receivable and payable transactions are particularly high. Retailers may offer extended credit terms to customers to stimulate sales, while manufacturers deal with numerous suppliers and intricate supply chains. Construction companies often face long project cycles, progress billings, and retention amounts, complicating the recognition and collection of receivables and the settlement of payables. The COVID-19 pandemic highlighted the importance of resilient accounts receivable and payable management. Many companies faced delays in customer payments and disruptions in supply chains, leading to increased credit risk and liquidity challenges. Organizations responded by tightening credit policies, intensifying collection efforts, renegotiating payment terms, and leveraging technology to monitor and manage outstanding balances more effectively. Ethical considerations also play a role in the accounting for accounts receivable and payable. Practices such as channel stuffing, inflating sales by shipping more goods than ordered, window dressing, manipulating payables to present a healthier financial position, or deliberately delaying payments to suppliers can distort financial statements and undermine trust. Ethical accounting practices, guided by integrity and transparency, are essential for sustaining long-term business success and stakeholder confidence. Corporate governance frameworks emphasize the oversight of accounts receivable and payable processes by boards of directors and audit committees. Regular internal audits, independent external audits, and compliance reviews ensure adherence to policies, detection of irregularities, and continuous improvement of processes. Whistleblower mechanisms and ethical hotlines provide avenues for reporting concerns related to receivables and payables management. Training and development of accounting personnel are crucial for effective management of accounts receivable and payable. Staff must be proficient in accounting principles, use of technology, communication with customers and suppliers, and problem solving. Continuous professional education keeps them abreast of regulatory changes, emerging risks, and best practices in the field. Sustainability considerations are increasingly influencing accounts receivable and payable practices. Companies are adopting green procurement policies, engaging with suppliers who adhere to environmental and social standards, and offering sustainable financing options to customers. Sustainable supply chain finance solutions, such as reverse factoring, enable buyers to support suppliers' cash flows while promoting responsible business practices. Looking ahead, the future of accounts receivable and payable accounting will be shaped by digital transformation, regulatory developments, and evolving business models. Blockchain technology promises to enhance transparency, traceability, and security in receivables and payables transactions. Artificial intelligence and machine learning are enabling predictive analytics for credit risk assessment, fraud detection, and cash flow forecasting. Open banking and fintech innovations are streamlining payments, reducing transaction costs, and improving access to working capital. Small and medium-sized enterprises, SMEs, face unique challenges in managing accounts receivable and payable due to limited resources, bargaining power, and access to financing. Solutions such as invoice financing, supply chain finance platforms, and government-backed credit guarantee schemes are helping SMEs bridge cash flow gaps and strengthen their financial resilience. In summary, accounting for accounts receivable and payable is a multifaceted discipline that encompasses recognition, measurement, recording, internal controls, risk management, and strategic decision-making. It requires a blend of technical expertise, ethical judgment, technological adoption, and continuous improvement. By mastering the intricacies of receivables and payables management, organizations can enhance liquidity, foster strong business relationships, mitigate risks, and drive sustainable growth in an increasingly complex and dynamic business environment. The journey of accounts receivable and payable does not end with their initial recognition and recording. Ongoing monitoring, reconciliation, and reporting are integral to maintaining accurate financial records and supporting managerial decision-making. Regular reconciliation of accounts receivable and payable, subsidiary ledgers with the general ledger, ensures that discrepancies are identified and resolved promptly. Aging schedules for accounts receivable help management track overdue balances, prioritize collection efforts, and assess the adequacy of the allowance for doubtful accounts. Reporting on accounts receivable and payable extends beyond the financial statements. Management dashboards, key performance indicators, and variance analyses provide real-time insights into collection and payment trends, enabling proactive interventions. Stakeholders, including investors, lenders, auditors, and regulators, rely on transparent and reliable information about receivables and payables to evaluate a company's financial health and operational efficiency. Collaboration between accounting, finance, sales, procurement, and operations teams is essential for effective accounts receivable and payable management. Sales teams play a crucial role in setting credit terms, negotiating with customers, and resolving disputes. Procurement teams are responsible for negotiating supplier terms, ensuring timely delivery of goods and services, and managing vendor relationships. Finance and accounting teams oversee the recording, reconciliation, and reporting of receivables and payables, ensuring compliance with policies and regulations. Dispute resolution is a common aspect of accounts receivable and payable processes. Discrepancies may arise due to pricing errors, quantity differences, defective goods, or missing documentation. Timely and effective resolution of disputes is critical to maintaining customer satisfaction, preserving supplier relationships, and minimizing financial losses. Establishing clear communication channels, escalation procedures, and documentation standards facilitates efficient dispute management. The role of technology in dispute resolution and exception management is growing, with automated workflows, case management systems, and artificial intelligence-powered chatbots streamlining the identification, tracking, and resolution of issues. These tools reduce manual intervention, accelerate resolution times, and enhance the overall efficiency of accounts receivable and payable processes. Cash flow forecasting is another area where accounts receivable and payable play a pivotal role. Accurate forecasts depend on realistic assumptions about the timing and amount of collections from customers and payments to suppliers. Scenario analysis, sensitivity testing, and integration of receivables and payables data into cash flow models enable management to anticipate liquidity needs, plan for contingencies, and make informed investment and financing decisions. Credit management is an integral component of accounts receivable accounting. Establishing sound credit policies, conducting thorough credit assessments, and regularly reviewing customer creditworthiness are essential for minimizing bad debts and optimizing sales. Companies may use credit scoring models, external credit reports, and trade references to evaluate the risk profile of customers. Periodic review of credit limits and terms ensures alignment with changing business conditions and customer behavior. Collection strategies for accounts receivable vary depending on the nature of the business, customer base, and industry norms. Common approaches include sending payment reminders, offering early payment discounts, implementing installment plans, and engaging collection agencies for delinquent accounts. Effective communication, negotiation skills, and a customer-centric approach are key to successful collections while preserving long-term business relationships. For accounts payable, supplier relationship management is a critical success factor. Building trust, honoring commitments, and maintaining open lines of communication with suppliers contribute to favorable terms, reliable deliveries, and collaborative problem-solving. Supplier segmentation, performance evaluation, and joint improvement initiatives help companies optimize their supply base and drive mutual value creation. Dynamic discounting and supply chain finance are innovative solutions that benefit both buyers and suppliers. Dynamic discounting allows buyers to offer early payment to suppliers in exchange for a discount, improving supplier liquidity and reducing procurement costs. Supply chain finance platforms enable suppliers to access financing based on approved invoices, leveraging the buyer's creditworthiness to secure lower-cost funding. Regulatory compliance is a key consideration in accounts receivable and payable accounting. Laws and regulations governing commercial transactions, payment terms, anti-money laundering, and data privacy vary across jurisdictions. Companies must establish policies and procedures to ensure compliance, monitor regulatory changes, and train staff on legal requirements. Non-compliance can result in financial penalties, reputational damage, and operational disruptions. The integration of environmental, social, and governance (ESG) considerations into accounts receivable and payable processes is gaining traction. Companies are evaluating the ESG performance of customers and suppliers, incorporating sustainability criteria into credit and procurement decisions, and disclosing relevant information to stakeholders. ESG-linked financing solutions, such as green supply chain finance, incentivize responsible behavior and support the transition to a more sustainable economy. Mergers, acquisitions, and corporate restructurings present unique challenges in accounting for accounts receivable and payable. Due diligence processes involve the review of receivables and payables balances, assessment of credit quality, identification of contingent liabilities, and evaluation of internal controls. Post-transaction integration requires harmonization of accounting policies, consolidation of ledgers, and alignment of processes to ensure accurate reporting and realization of synergies. Fraud risks in accounts receivable and payable are an ongoing concern for organizations. Common fraud schemes include fictitious sales, lapping, misappropriation of receipts, unauthorized payments, and vendor impersonation. Implementing preventive and detective controls, such as segregation of duties, system access controls, transaction monitoring, and whistleblower hotlines, is essential for mitigating fraud risks and protecting organizational assets. The role of external auditors in verifying accounts receivable and payable balances is critical for ensuring the integrity of financial statements. Auditors perform substantive procedures, such as confirmation of receivable balances with customers, examination of subsequent cash receipts, and review of supporting documentation for payables. Analytical procedures, such as trend analysis and ratio comparisons, help auditors identify unusual fluctuations and potential misstatements. Management of accounts receivable and payable is closely linked to broader financial strategies, such as capital structure optimization, investment planning, and risk management. Decisions regarding the use of trade credit, factoring, or supplier financing have implications for leverage, cost of capital, and return on investment. Strategic alignment of receivables and payables management with organizational goals enhances value creation and competitive advantage. The globalization of supply chains and customer bases introduces additional risks and opportunities in accounts receivable and payable accounting. Political instability, currency fluctuations, trade regulations, and cultural differences can affect payment terms, collection practices, and dispute resolution mechanisms. Companies must develop robust risk management frameworks, diversify their customer and supplier portfolios, and leverage technology to navigate the complexities of global commerce. Continuous process improvement is a hallmark of world-class accounts receivable and payable management. Benchmarking against industry peers, adopting best practices, and leveraging process automation drive operational excellence and cost savings. Lean methodologies, Six Sigma, and process reengineering are commonly used to eliminate inefficiencies, reduce cycle times, and enhance customer and supplier satisfaction. Change management is essential for successful implementation of new technologies, processes, or organizational structures in accounts receivable and payable functions. Engaging stakeholders, providing training, communicating benefits, and addressing resistance to change facilitate smooth transitions and maximize the impact of improvements. In conclusion, the accounting for accounts receivable and payable is a dynamic and multifaceted discipline that underpins the financial stability and operational success of organizations across industries and geographies. It demands a holistic approach that integrates technical proficiency, ethical conduct, technological innovation, and strategic foresight. By mastering the principles and practices of receivables and payables management, Organizations can unlock working capital, build resilient supply chains, enhance stakeholder trust, and drive sustainable growth in an ever-evolving business landscape.